Good morning, everybody. Welcome to the Flow Show, Monday, the 19th of May. And some decent moves for the start of the week to be taken into consideration. Let's see if they continue today and this week. Morning, Kay. How are you doing, mate?
Morning, Ryan. Yes, I'm doing fine. We had, I hopefully not the whole of our summer over the weekend here in the southwest UK. We are upbeat because the weather's been nice over here.
Yes, we have been spoilt the last few days, but a bit grey today. My garden could do with a bit of rain, so I'm not going to knock it if we get it.
It's gonna come. It's gonna come. By the
Yeah.
end of this week, we are going to be complaining that it's raining again.
Oh, great. Look forward to it. Just in time for the bank holiday, of course, coming this next Monday. Anyway, we'll talk about the weather a little later on this week, no doubt, to have another little moan up. Right, let's have a look at what's going on in the world. Going to start with some data out of China over the weekend or early this morning. Quite a bit of data out from those guys. We've had retail sales coming in at 5.1%. This is year-on-year numbers, missing the 6% expected, but still a healthy number. Countries this side of the water that were killed for numbers like that. Industrial production was better as well, coming in at 6.1%. So not seeing any drop-off yet in any of the data over there in China. Even the unemployment rate for April came in at 5.1% versus 5.2% expected and prior. So they've had a little bit of a export boom, but some of the other data is playing ball as well, as much as you can trust Chinese numbers, of course. China's Stats Bureau said the economic recovery is resilient despite external pressures. China's commercial banks sold a net $4.3 billion worth of Forex in April. That was versus a net sales of $2 billion in March. The net sales so far between January and April coming at 61.9 billion. So we know, particularly in the early part of the year, they were intervening in the currency, selling dollars. That looks like it's continued in part. Kay, they're still keeping a very, very tight leash on the yuan.
Yes, they do. And I was looking at those numbers. I think if you look at those net sales, I trust a fair part of it went into got recycled into gold. Well, maybe not the major part, but at least yeah they do, Ryan. And so far so tight. They are managing to keep it there. And sometimes what the best is for your currency, if you want to, if you've got other stuff on hands, the external pressures, we all know what they are, is that nobody watches your currency anymore, and it's just quiet. I think they must be overjoyed with the way that the yuan is trading right now, whether it be the on and or the offshore. So yeah, I think PBOC. Chinese Ministry of Finance wise, they must be pretty happy with the stability of the yuan of late.
Yeah, well, they're the ones who are controlling it, so they've got every right to
Yeah,
be happy.
yes, yes, but you still and these things are relatively known these days, but you could still have a lot of speculation going on. But it seems that they managed to quiet down speculators quite a bit.
Yeah, the threats of black vans turning up at your door tend to do that. And the men
Well,
in
I
dark
mean,
suits.
maybe a
I
bit
get
less
what you mean.
now. Maybe a bit less now, but $3 trillion is a bit hard to go and fight if you want to take on a currency.
Yeah, exactly. Moving on to the SMB last week, Schlegel once again banging the negative rate drum, saying we cannot rule out that negative rates could be a necessary instrument in the future, despite the fact that the SMB doesn't like negative rates. They dislike them so much that it seems to have to bang on about them every time they pop up in the presses. So that tells you everything you need to know for that. Barclays are expecting the ECB to cut rates in June, September, and December, taking the rate down to 1.5%. Those are forecast meetings, you might note there, because they expect to pause in July. ECB's Wunsch over the weekend said the central bank may need to cut rates below 2%. So a lot of banks actually got their forecasts below 2%, but the ECB are not quite there yet in indicating that. So Lunch has just said that himself. The EU Commission has surprisingly cut Eurozone GDP growth forecast for this year to 0.9 from 1.3% in their prior forecast in November. Also cut next year's growth to 1.4 from 1.6. Absolutely no surprise. Those growth forecasts coming down. And all this economic resilience isn't coming into these forecasts, at least. The UK and EU have cobbled together a deal. It's been called the Brexit reset deal. Over they want to fucking spin it. In terms of what it all means right now, not a lot. There's agreements on fishing, agreements on food safety standards and all that sort of crap, student exchanges and all that rubbish. There's nothing intrinsically good for markets to get their teeth into in terms of trade. However, it is the EU and UK talking. They are moving towards getting better relations going. Oh, there's me squawk going. I thought I switched that off. Let me do that. Apologies for that. So yeah, the UK and EU are on a path to a better relationship post Brexit. Now, there's going to be a lot of noise coming out of the UK in terms of the usual leavers versus remainers fight and who's selling out, who's sold to the devil and whatnot. For markets, it's positive that there's talks going on and that trade may become easier. Even things like getting through passport control might be getting easier, which I won't mind at all. So for the pound, this is maybe yet another reason why we've seen the pound a bit supported of late compared to some other currencies, just because they are talking. So this is a watch this space moment. The details right now don't mean an awful lot, but it's the fact that they're talking and working towards potential agreements is more important. So just keep an eye on those headlines moving forward if we do start hitting some big stuff like proper trade and anything else. Okay, are we going back, do you reckon, to the times when we have to, when the UK has to send its monthly fees to Bubba?
Checking euro sterling. Hold on. Where were we just before Brexit? It's
the old days.
We all know it's not going to go that fast, and probably not going back to pre-Brexit scenarios. But as you, I think that's the word that you use there, is the one that is the most important. It's the path. It's the path is sometimes much more important than the results, right? But it's the path. So for as long as they continue to talk, to have work groups, the positive effect on sterling could remain visible. Now, is it the effect? And I was wondering a little bit because the nuances will be probably impacting more euro sterling than maybe the cable, because that's where now the nuances will start to pop up between the EU and the UK for the external look at it. As we've already said, it is very positive that those talk and that there are, even in parts, deals signed and they continue to talk, they continue to work together. But for the euro sterling, and to be fair, I'm still short euro sterling, but I'm starting to think it's maybe time to reflect a little bit on that. For as long as we stick above this 83.90 figure, maybe even 83.60 or so, maybe that's where we need to be a little cautious now and looking at the nuances. So therefore, I tightened the leash on my remaining short euro sterling, but I'm looking more positive at cable than euro sterling, for instance. Yeah, but I think it is the path which is the most important there. Indeed.
Yeah, and this is all going to be more positive for, if you're talking euro sterling, it's going to be more positive, well, for the UK than it is going to be for Europe. Hence why euro sterling may be the bigger mover in all this versus other dollar pairs, euro pairs, and whatnot. Right, coming back to the data from last week over in the good old US of A. We've got a fair bit out on Friday. Housing starts, building permits coming in a little bit mixed. Starts were up, permits were down, but nothing in there really that should get anyone fearing the worst from the housing market at the moment. But keep an eye on that as always. Import-export prices may be a bit of a surprise there. Import prices in particular were expected to drop to minus 0.4%, but they came in a positive. This is April data, maybe some knock-on still from trade and stuff going on in there. Export prices the same as well, were expected to drop. They also came in higher, 0.1%. Michigan came out as well, the flash number for May, and consumer sentiment going backwards again or further down, shall we say. Pretty much all the metrics coming in worse as well. Current conditions, expectations, and another big jump for the inflation numbers, both the 1 year and the 5 year jumping up as well. Now, it's not the level that matters in these inflation numbers, it's the trajectory, the trend that we're seeing in this. And as much as people slag off surveys, at some point, as I've been pointing out, if people are feeling a certain way, it will start impacting and influencing the way they spend, the way they save, the way they borrow, and all sorts of things. So that's what we need to look at. Okay, it's not a light switch moment. Okay, where you get a bad Michigan and then all of a sudden the economy falls off a cliff. We know the hard data isn't turning yet, but there are some small signs that there may be trouble brewing. I'm not going to say the retail sales last week was the turning point, but it wasn't particularly hot. We'll see what the next one is. If it goes negative, then maybe we are on the cusp of starting to see some of the hard data catching up with some of this survey data. But anyway, that stuff wasn't too bad in terms of the housing starts, but the Michigan stuff looking still wonky. That may or may not have affected the New York Fed's GDP nowcast, which takes Q2 now at 2.35% for GDP from 2.42% prior. I don't really keep much say in those numbers. They are a bit wet finger in the air. Also, you can see there the Atlanta Fed GDP now coming in at pip below at 2.4% as well. But both predicting solid numbers. Predicting solid numbers for the second quarter. Right, let's get into what happened Friday evening. Moody's decided to downgrade the US rating agency ratings to triple. Jesus wept, it's Monday and I'm tongue-tied already. Let's start it again. Moody's downgraded US from AAA to AA1. And they changed their outlook to stable as well. Got the market in a bit of a hop on Friday. Got everyone, well, the usual suspects screaming and shouting that this is the US just about to disappear up its own backside. Moody's AAA rating was the only rating agency to have a AAA rating on the US. Everyone else was that one step lower. So first and foremost, Moody's was the outlier compared to all the other ratings agencies. Okay. Are they a big one? Yes, of course. But we're in a world where, as Mark pointed out in our chat room, very few of the majors have AAA ratings anymore. And funny enough, there's more than a dozen US states that still have a AAA rating from Moody's. So some of the states within the US have a better rating than the government. So it's not all doom and gloom in terms of ratings. But anyway, we're seeing a bit of a reaction. We got a bit of reaction Friday. We got a bit of that kicking over the weekend. Whether we're seeing a bit more of that reaction today is possible. Yields are blowing up a little bit across the board, particularly in the US, of course, but they are going up across the board. When I heard this news, I pretty much dismissed it as not being overly important because, as I say, not many countries have AAA ratings anymore, so everyone's setting their sights lower. The only possibility was that it could sometimes cause a bit of asset reallocation if there are still firms out there who will only invest in AAA rated assets. But again, as Mark in our chat room pointed out, not many people do that anymore and haven't been really since the great days of the GFC and banking crisis where all the ratings got cut anyway. So I don't think it's a big deal. It's probably not a big deal. What the markets do with it is another question. And whether they turn it into a big deal or not remains to be seen. The US Open is going to be very important because if the Yanks come in and think, nah, this is a load of old crap, they're probably going to buy the dip and we're probably going to see the dollar rallying, stocks rallying again, yields coming back down again. So this is another moment. Don't get sucked into what the market's is telling you now. Wait to see how the Yanks respond to it and whether they're going to continue it or they're going to reverse it. Besant was out and he dismissed it, saying he doesn't put much credence in Moody's. He calls these ratings a lagging indicator. Kay, what are your thoughts on all this stuff? Is this the market just having a bit of a paddy, or has he got something it needs to do about this?
As I've been updating on Saturday, I'm not going to dismiss it completely, but then again, also thinking that it's going to be very important what the US market do with their own players do with their own markets, obviously. The thing, yes, is just a very much delayed catch up on what S&P and Fitch have been doing. Also interesting is to know, and I've read this also over the weekend and posted it in our newsroom, that according to Basel rules, AAA, AA does not necessarily mean that there's going to be more protection needed or there's going to be a big change in portfolios. But Basel rules, they are banks, they are some funds, asset managers, but they don't cover sovereigns. And then you think about what's going on in the global picture about potentially tax cuts to come in the US, debt issues perhaps raising, and I have been basically shrugging off debt issues for the past 40 years because they've only had, if they had an impact, a very short-lived impact, so that is still possible. But if you look at it with everything that's going on, I would call this move a pretty logic move, that the dollar is coming down, and we will have to see over time. It's not going to have an impact immediately. Now I may be wrong, and the euro dollar trades 117 at the end of the week, which is possible. But we have to know that, for instance, most of the EU are AAA. As a matter of Australia and Canada are actually also AAA, but they are typically not the biggest markets where investors would turn around. But then I'm thinking about Europe, for instance, and that's a big block. So for those, and then I'm thinking about sovereign wealth management, even central banks around the globe. Wouldn't they be tempted to hold a bit more euros now than as compared to before? I don't think this is the people talking about the dollar losing its reserve status. I don't think that we will see it in our time in markets, but you never rule out, and we have seen moves in currencies, we have seen moves in countries or blocks assets, and really just going to put it all in context with what we are seeing now, I think there is a potential impact, and I would not dismiss it. This just this period, because the market seems very still cautious about a lot of things, and we've seen those flip arounds. Um, Remember, like a month or a month and a half ago, we were buying dollars as if there were no tomorrow, or with the euro dollar going down to 102, and then we have flipped since. But I also said, I mean, when Trump and his administration started to cut on the tariffs, they're still leaving some for one, and the currency has not fully corrected when he came back. We only went down to 110.5 in the euro, right? So I still think that there is a potential impact here. So that is why I was saying over the weekend and putting my money where my mouth is as well. And as soon as the market opens, I'm going to be selling a few dollars. That's what I did. But again, I'm as usual already slicing and seeing if we can really break the levels, because we have seen reversals all around over the past months and even years. So always remain a bit cautious. But I would say it has potentially an impact. So I'm going to perhaps diverge a bit on my opinion towards those who says it's a non-event.
Yeah, nice grabs, mate, on those dollar shorts this morning or last night. Some nice moves going ahead, indeed. Right, so yeah, we need to keep an eye on how it's taken all in the US. I mentioned what Besant said. Well, Trump's been out and about, and he's moaning more about what Kamala Harris paid Bruce Springsteen for his poor performance during her campaign for president. That's how much credence he's given this rating stuff. But he might be looking at markets this morning whilst on his morning clear out, shall we call it? So we could be getting some truth bombs from the toilet this morning about that, and no doubt he's going to call Moody's the worst rating agencies the world's ever seen, or some such like. But we'll wait for that reaction anyway. Coming on from Besant, he had a call with Walmart CEO saying that Walmart will eat some tariffs because they've been moaning about how much it's going to cost them, and he said, well, you know, man up and take it. However, that's going to go down remains to be seen. He expects faster GDP growth than debt under the tax bill. And this tax bill has, I think, passed one of the stages in whatever house it's gone through. So there's a possibility of that progressing further this week. He says most countries are offering very good proposals on tariff terms, and warns that non-compliant nations will get a letter with a US tariff rate likely at the April 2nd level. Japan isn't happy about any of it at the moment, and this might be going to be causing a bit of a problem. PM Ishiba said US tariffs on cars are unacceptable, and over the weekend, they've also been doing a lot of pushing back about accepting any tariffs from the US and saying that the US has not been appreciative of prior deals under Trump 1.0, his first term. So then they're putting up a bit of a fight against this. Economy Minister Akazawa says the schedule of next US-Japan trade talks are not set yet. Kay, the relationship seems a little bit sour this time around between Japan and the US, and what's this going to lead to? I'm surprised we're not seeing yen weakening on this, let alone strengthening as it is today.
Yeah. Okay. I think there's a lot of dollars going around, probably, but I agree. And we're seeing yen just a tad, but a tad weaker through some crosses, but it's nothing to write home about. Maybe more having to do with the euro strength than yen weakness, if any. Yes, the Ishiba seems to be wanting to sorry, to play a bit hardball. Well, I mean, people say that it's also to beef up his ratings with the upcoming election later in the year, which is possible. But I think they have a serious argument, right? I mean, there's a lot Japan is doing for the US. Yeah, I know, agree and things, but they do take energy. They do invest huge amounts in. They are the biggest investor in the US. So, and they are willing to invest even more if you look at the companies. I Somewhere I think they are right because they in the Japanese way, because they will never say it in such words, but they find or think that Trump and his administration are taking the piece, and I think they are right. To play a bit hardball, there is instead of tariffs, there are other ways possible, like quotas and maximum investment percentages in U.S. companies and things like that. But uh, they are not manipulating the currency right now. Yields are on the rise as well in Japan. There is no such thing as manipulation going on right now, and I think politically and geopolitically speaking, they are the buffer in the Chinese zone, and they should use it as an argument as well. So I actually don't know how it's going to completely work out at the end, but psychologically, I quite agree with Japan on this one.
Yeah, yeah, absolutely. I'm in the same boat, I think. Yeah, whether we see that play out in the end, I don't know. But let's see. There's talk that they might not even get a deal ahead of the July deadline because of
Yeah.
those elections. So I don't know if we're going to see a late rush to get something cobbled together or a can kick put in place. But if they go over the deadline without any deals, then that's going to put a heap of pressure on Ishiba at those elections as well. So it
Mm.
may be in his interest to pull a last minute deal, as I say, at least a can kick before those elections rather than letting it slide over. Because as I say, you won't
Yeah,
really be going into.
he's going to be judged on the quality of the dealer.
Yeah, yeah. I think he's in a bit of a damned if he does, damned if he doesn't
Yeah,
scenario. As
yeah,
far as that goes.
definitely. Because
Yeah,
um, they, in the last elections, he was a bit fortunate that the opposition still hasn't got their act together and put like one serious candidate. They always they don't agree among themselves in the opposition. So that's been a bit of a lucky shot, but he may not be lucky twice or three times, you know.
yeah. What election is it? Is it a full election or is it just one of the houses?
Let me see.
Do you know?
No, I think it's Ali, how do you call it? The diet, eh?
Yeah, it's a
I
full
think
one,
it
is
is
it?
one.
Yeah. Okay. Well, we got plenty of time to get the scorecard ready for that one anyway. But yeah. Okay. Right. Moving on. Just one other thing we've got coming up. A
It's
bit
a
of
partial,
headline.
by the way. It's a partial, by the way.
It
It's a
is a partial, is it? Okay.
Yeah,
Cool.
yeah, for half of the House of Councillors.
Cool. Thank you, mate. Yeah, a bit of headline list coming up today around 3 o'clock UK time, BST, because apparently the Kremlin have put out that Putin and Trump are going to hold a phone call at that time. This is all going to be in relation to what's going on in Ukraine and whether they can get Russia to agree on a ceasefire, which is only going to be a 30-day ceasefire, but it's a start if we get there. So be on guard for any potential risk headlines coming from that or the opposite, and it all going a bit Pete Tong and nothing coming of it. But that's what we got coming up a bit later anyway. Anything else for anything else, Kate?
Uh, no, no. I think we've covered what we needed to cover.
Good, good. Right, we're going to have a little butchers of what's coming up this week. Not a lot today. A bit of NAF, whatever that data is, leading indicators, load of old crap from the US today. Tomorrow, RBA, where the majority of people are expecting another cut of 25 pips. You remember that the Economist poll last week had 42 of 43 expecting a 25 and one expecting a 50. So expectations are for a cut. Any surprises you think we'll get from that one? Would they maybe indicate that they're going to keep going, Kay, or is this going to be another one and wait and see?
Yeah, it's one of those where the data tell us they shouldn't, but the psychologists or how you call it say they may. The market sides with a relatively hawkish cut, which I can agree upon because of those pretty decent jobs report that we had. So we will see. It's a bit of a like with every central bank, it's going to be a bit of a border of the coin, side of the coin. It could drop either way, but the cut seems pretty much there for the RBA down to 385. Yeah.
Yeah, exactly. And it would be a shock if they didn't cut. So that's the way to look at where the big price move is going to be. We also get Canadian CPI later on tomorrow, which will be factored into obviously being Bank of Canada thinking as well. Wednesday, we start kicking off with some data out of the UK. We get CPI numbers where CPI is expected to jump a little bit. Well, quite a bit actually. Seeing, I think 3.1%, 3.2%, something like that. I don't know if it shows it on this one yet. Oh, there you go, 3.3% from 2.6%. So a bit of a jump expected in that number. A bit of a high bar possibly for that CPI. If it comes in less than that, then the markets are probably going to rejig their thoughts for the next Bank of England cut. Oh, bloody hell, I've lost it all now. Where's it gone? There we go. Shut it all off. Not a lot out from the US. NBA data. Nothing else on Wednesday. Thursday, it all happens though. We start getting the flash PMI numbers coming in from around the world. This is obviously the May numbers kicking off this week, starting over in Asia. We get a few, and then we come into Europe, UK, and then going through to the US later on that day. As for the rest of the US data, existing home sales coming out, but apart from that, not a lot else in terms of the US data. On Friday, we get Japanese CPI data. I don't know if I missed the last Tokyo numbers, Kay. What were they like?
The what? Sorry?
The last Tokyo numbers. This is obviously after the...
yeah, if I recall, slightly hot.
Yeah, I'll have to have a look at that. But anyway, these are the national numbers from Japan coming out in their morning. Then we get UK retail sales as well. We get to see if the first 3 months of the UK sales, which have been pretty good, are going to continue, or whether they're going to fall off a cliff. These are numbers for April, which will include Easter and will include some nice weather. So it's possible we get another decent one there. Then we get some revised GDP numbers from Germany, Canadian retail sales later on, and some new home sales from the US. So data-wise from the US, not a busy week. So we're going to perhaps have to deal with some other headlines to get a bit of inspiration going for that one. Anything else tickling your fancy this week, Kay?
Yeah, I mean, I think for Sterling watchers, we're going to have to watch very closely the opening of the Chelsea Flower show tomorrow. Nah, I'm joking. I think we covered everything, mate.
Chelsea Flower Show. Yeah, I've spent the last 2 weekends in my garden, so I'm done with flowers for the moment. And digging and shoveling and everything else. So that's the week coming up. So be mindful of what's coming this week. Before we start looking at some prices, just to remind you of the sale going on at our platform, 40% off a monthly subscription, and we're still getting plenty of people coming in on this deal. Good to see loads and loads of new people coming into the room and into the conversation and keeping things ticking along. So this has only got a couple more days, I think, before it gets pulled. So if you're umming and ahhing, now's the time to do it. Get in quick. Snooze you lose, as we say. Right, where are we going to start looking at? Well, I'm looking at dollar yen, and I did try a little short earlier because I was looking at this area, this zone of mine, to see if it was going to break and hold below 145. We are doing it. We are holding below it, but it's not exactly going big guns. I wanted to try and I had this idea this morning, and I probably missed the trade that I should have taken, which would have been somewhere in this move from 145 to 144.60s. And then I thought maybe this trying it a bit later, a bit of a chase trade. I don't actually think that this downgrade news is anything that is worth worrying about for the long term. I am concerned that the Yanks come in and think, fuck it, and just we don't care and start buying anything back. So I was in two minds that I'm trading against what I think the reaction might be. So I've scratched out of that anyway. It's trying to hold below, but it's not really going gangbusters, and that's got my caution up a little bit. If it does continue, though, we've got a bit of support coming in a bit lower down. We've got this moving averages on the 4-hour chart to keep an eye on as well. We got a bit of action around the 144.5 mark to 144.40s. Then we got the 50 of this move up from 22nd of April to look at 144.26. And then we got plenty of action coming into the 144 figure. Top side, we're banging ahead on this broken 38.2 fib 145.30. So keep an eye on that if we do get a bounce today. If we get a bounce from here that can't get through that, that's going to suggest that we're going to keep this trend going. And then a secondary move through this zone here might be the one that really heads lower. But if we're knocking above back that, if the Yanks do think it's going to come in and buy the dip, then we could be mooching up to 146 again pretty quickly. So a lot of two-way risk for this one in the main. Dollar CAD, this one's still failing to get and hold any length of time above this 139.70.80 zone. This is still looking a bit dead cattish, this bounce that we got at the beginning of May. Okay, it's only rallied, 250 pips up to 140s, just over 250 pips, and it can't really sustain any moves above this level. I've been highlighting the 140.20 when we were making these moves, and that it really is your line. It needs to get above there. We're not falling out of bed though. We're still trying to keep these higher lows, but I think this is a clock one. And if we fail again up here, or even if we don't even get up there, then there's an every chance that we have a steeper pullback. Might get down to the 30s or even go through it, 139.29.30. I'll be thinking if we do get a fail here, we're probably more likely to head for 139, which is the bigger level down below. Also keep an eye on my dollar MEX, because I managed to take a short last week at me 52 and then got stopped out pretty much at the high of the day on Friday before it turned tail again. So even when you get the idea right, sometimes you can just get your management wrong or your levels wrong in terms of stops. But we've had a little test of this 41.42 level already today, and it's holding up there. So it's still got a bit of work to do. Get under there, then we might go and test this 38.2 again, and we need to get under there and hold under there to start changing these lows and heading lower. But the same levels on the way up need to be considered. We've got this sort of minor level around 46 just to keep an eye on. I think the 51.52 is going to be important again on any rallies. But again, if the Yanks come in and decide everything's tickety-boo, this might be going higher again. Depends how the market wants to take it. And I want to have a quick look at yields because, as we said, have a look here. Pretty much every yield you want to look at is rallying at the moment, including Japan. Okay, I'm seeing a few people getting a bit antsy about Japan yields at the moment. Obviously, the higher they go, the more pressure it puts on the government and whatnot. But is it anything we need to worry about, or is this just caught in the same tide as everyone else?
think the worry that and I read several articles. The worry that investors now have, and especially the Japanese investors, are that they are a bit worried that the about a trade with between the US and Japan. So they are reluctant to invest much in the longer term now. I think if we would get a trade between the US and Japan, you will see the Japanese investors pile into the longer end of the Japanese curve again, and then the whole thing should quiet down. But now they indeed have a bit of yeah anxiety or thinking they may need to take losses because we know that they are heavily invested in U.S. bonds and they are not really going the right way. Right now because they could be looking at a few losses there as well. Um, so they are reluctant right now. So for them, I think it's going to be one important that the Bank of Japan speaks clear language to because Bank of Japan is still on a hiking path, and Ueda at least has confirmed it, and people close to the Bank of Japan say yes, they will continue to hike. So um, the Japanese investors were already waiting to see up to where the yields could rise before they start to perhaps repatriating or investing the new funds rather in JGBs. But then they really said that they were cautious right now. So. Could this spark a round of Bank of Japan bond buying because they are tapering in the meantime as well? I think it is possible just to calm down the spirits for as long as there is no Japan-US trade deal. They may have to step in at one stage, but we should not expect the Bank of Japan to intervene style um, Bank of England when things went wrong with Truss and Kwarteng, or ECB style when things are going wrong, or not even thinking about how the Fed handled the injections on big events. This will be a way to calm down markets, right? So, but they may need to come in and calm things a little bit.
Yeah, yeah.
There are
Thanks,
just
mate.
not enough buyers. There are just not enough buyers of the long end in Japan right now.
Yeah, I've just seen a headline popping up that Japan's economy minister Akazawa is going to visit the US for trade talks as soon as this week. I don't know if that's a source's piece or whatever, but they were saying they had no plans for future talks, but it seems like they're going to be meeting up for talks as soon
Well,
as this week. We've got the G7 thing going on this week as
yeah,
well, haven't we? So,
yeah. I think Kato was already well, not scheduled perhaps, but Kato was already hoping to talk to Besen as well, and I guess Akazawa will be there. Ueda will go to the G7 as well, so the whole Japanese official dom will be there.
yeah, yeah. So, okay, Japan's one thing. Why are we seeing yields rallying across the board? I mean, this is more a risk-off move because you think if this was just US downgrade stuff, you'd see a run out of US
Mm.
into other assets. But this is a at the moment it's looking like a global risk-off shift. And the money's certainly not coming out of bonds and going into stocks at the moment because they're all in the red as well. So what are we seeing at the moment?
Yeah, I think it's the whole thing, you know. I mean, if you the tariffs have been scaled down, but they've been kept at the base 10% level, which is still higher than where they were before. So we've had the front running of the whole thing, and that went that got not reversed, but at least retraced. And now we are still looking at that. Then we are looking at a round of tax cuts in the US. Then we are looking at other countries will also have higher tariffs to pay to the US, and it's Yeah, I think that's what we are doing now. Debt is coming back to the fore. Credit perhaps. So people are starting to ask bigger premiums for the yeah for the asset buyers and debt buyers, and I think that's where we are at right now. The market uh, is really worrying about especially US, but it has a ripple effect on the whole world if something happens in the US, right? About higher debt and that debt, if you look at again, it's Moody's. One could argue whether we should really pay attention to it, but if you're expecting that debt is going to rocket above 100 towards 106% of GDP, that's where you see the long end of the curve all of a sudden getting worried about it, and that is where we are at right now. Um, can it calm down? Yes, of course. Will it calm down? I'm afraid that in a way, it's only going to calm down if we see lower growth numbers, which are going to be depressing yields somewhere. But it's probably not going to help the asset market in any way because that would be a confirmation that stuff is going wrong. So I think the market is trying to really protect or yeah, pay protection against bad stuff to possibly hit over the course and the rest of the year.
Yeah, thanks, mate. Right, I'm going to bang it over to you, mate. If you've got a couple you want to look at.
Yeah, so euro dollar, everybody, his dentist, his taxi driver, his butcher was watching this 112.70. Well, here we are. We did break through this trend line, but I would say like we were looking at this trend line up at 113 in the 113s here already. Then we were looking at it the other day around 112.70 again, where the level was. Now it's trading lower. I'm always a bit reluctant to really hang my hat on to this kind of stuff. But the fact that we are now trading shyly, and as we said, we still have to see what the US wants to do with its market, shyly above this 112.60/70, we really need to pay attention to that. If the US starts to put it back below 112.40, it could again have been one of these blips and one of this kind, for instance, and then we go and have a look back down. Now, if the US comes in and sells dollars, we could be on our way to 113.80 with a bit of an intermediate stop around 113.20 perhaps. But this is possible. As I said in the room and earlier on the show, I didn't like the combination of all those things that I've been talking about and we've been discussing with Ryan today. And yes, the market this can only be a short-term blip, but all those long-term as well things, they if those yields would be higher in the US due to a really good growth and solid data, I would say that, yeah, I mean, this is just a blip in there and we're going to go back down. But the reasons why we are up here are not those that are pushing me to be at least not long, but yeah, they are pushing me to be a bit short dollars. I'm probably, as I am a trader and a relatively active trader, probably going to raise my stops on the position where I was initially having a stop below here. I'm probably going to raise it all the way up if we close above 112.70, especially. But I think there is a possibility that we are on our way to a bit higher levels here. Again, we will see what the US wants to do. Cable broken above the triangle. Sorry to read it, Ali, but it was easy to put a stop just below here. I think many people have been a bit perhaps taken out on this Friday move. But as I always say, I mean, a level is a level. But look, I mean, we've already traded below algos, whatever Friday moves. I always like to look at it a little bit wider, perhaps when I have a position. Um, but yeah, now it's moved up. We're broken above 133.35, 40, which is in line. If you look at the euro sterling, it's not really moving a lot. So it's logic that we have similar moves in the euro than in the cable. But again, there as well, I was particularly looking this at this 133.60. We're through now as well, trading around 134, which is the prior high here on the cable. I think we can visit the move back up there, especially if we confirm globally in the dollar, and then we may even be looking at 135s. And if you look at this here, 136s, if this move sticks, obviously, in the short term, and again, look at what Europe does, US does. If we start to get back below 133, 35, 133 and a quarter, I don't think this move is going to stick. But in the meantime, we've broken through the levels, so respect those levels, I would say. All right, Aussie, Kiwi. As I said, there's always one of those antipodiums which is not particularly playing ball. This time, although we are trading a bit higher, this time Kiwi is a bit of a slow one, but we did hold this trend line on Friday, which is very interesting. So that's now coming in at around 58.70. I think this is good enough to pay attention to, and we are back above the hinge that we have been trading around 59. You know, since a month or so, we're trading up and down through 59. It's really the hinge of the market. We are a bit above. First indication would be if we lose 58.95 figure again, that it may again be a false starter. But if the dollar continues to lose ground this afternoon, keep a small eye on this 59.15 here. But then I would say 59.30, and then we're looking at mid 59s again. They really need to go before we can dream about a move up into the 60s again in the Kiwi dollar. For the time being, it's just a global dollar move, but the Kiwi, Aussie, to a certain extent as well. Not really following the whole move that cable and the euro dollar are performing, but we have the RBA next night as well. Okay, so we are turning around the 64.40 here on the Aussie. Interesting is that we had a couple of lows here in that around the 63.90, 80, 85.90, which have been holding. This is a level that has traded before as well. So that's your first support level, I would say decent support level on the downside. And then we are talking about those mid 63 against if something dramatic would happen on the RBA. Look at what's happening in this zone here on the Aussie dollar. If it breaks below, stop, run, and then we start to go higher again, or if there is really something more going on. So two things to monitor now is the afternoon in the US and how the RBA will handle the likely cut that we are going to have next night for us here in the UK. If we get a hawkish one, and if the dollar is continuing to weaken, you have a look here. 64.80 could be a bit of an intermediate one, but I'd rather say 65.15 is going to be an interesting level. And then especially what I would say, pay close attention. This line, I don't know whether I really should keep it, but pay close attention to what could happen around 65.5. Okay. By the time we are there, we're probably going to be trading something like this if we get there. And 65.5 is going to be pretty important because it's also a bit of a low here, bit of a high here, trading that into we were trading that in 2024 as well. All right. For the time being, this is starting to look like a bit of a channel here. So for as long as we are in it, watch those that channel develop. Gold, silver. Okay. Gold, silver, US is closed. No. Canada is closed. I think today, Ali. Not the US. US is not closed, I think. Gold. So we had the bounce on Thursday of that line, and then on Friday we came back down, and then came the obviously came the Moody's news. Gold needed again, it seems, as a hedge. we bounced, but we are kind of banging our head against those prior highs here. So we are going to need a move through 33.5 and up to 32, 65, 66 here. If we break above there, then I think we are going back into the 33s again. US, let's see what they do, because they obviously have a big key of what the markets are doing. But if we start to push through this 32.65, we could be back into the 33s pretty quickly, depending on how the mood is in the US markets when they come in. Okay. Downside 32. Well, you know the levels by now. 32, 31.90, back around at 31.65. But put that trend line on your charts, because that is exactly where we stopped. Sorry, on Thursday. It's one that comes from December 2024. Okay, for those not having it uh, on their chart. Okay, I think this is an interesting one, and that's why I colored it red as well. Last one. Oh, are we already at that time of the day? Last one. This zone in silver between 3160, 3180 is shaping up as being a solid, or at least a very good support. But I'd argue we still have to break back above 33, 3280, 85, and I would like to have the confirmation between above 33 and a quarter to tell me that we are back off to the races. Before that happens, I think we are just trying to trade this one here. And that's it for me, Ryan. Back over to you, mate.
Thank you very much, mate. I think good stuff as always. Have a great week, everybody. Have a great day. Come and check us out again tomorrow. Otherwise, you'll see us later on Face. Have a good week, everybody. See you later.